Dubai's inclusion in the UBS Global Real Estate Bubble Index in 2025 with a score of 1.09, which is elevated risk, has sparked discussion among investors. But what does that really mean? Let's analyze the data, not the headline, and unpack how UBS evaluates risks, what's driving Dubai's ranking, and what does this mean for investors in 2025. UBS measures how far prices have diverged from long-term fundamental using price-to-income ratios and price-to-rent ratios, inflation-adjusted price growth, mortgages and leverage data, construction activity, and absorption rates. Cities scoring above 1.5 are classed as bubble risks. 0.5 to 1.5 is elevated, and in 2025, Zurich and Tokyo, as well as Miami, led the risk table. Dubai remains at a safe 1.09, which is below moderate, and below traditional hotspots like Toronto or Munich. UBS emphasizes that this category does not predict a market correction, only that prices have grown faster than long-term averages. So, why is Dubai's rise different? UBS itself classifies that Dubai's score increase doesn't imply a bubble. Unlike highly leveraged cities, around 70% of property transactions here in Dubai are cash-based, limiting systemic exposure. Mortgage growth remains controlled, and regulation around escrow account and phased project financing prevents speculative overbuilding. At the same time, the city's population has expanded by over 15% since 2020. Roughly 500,000 new residents, driven by migration, corporate relocation, and long-term visa program. This is structural demand, not speculation. And that demand continues to outpace new supply. Strengths and limitation of UBS's framework. UBS's model provides valuable global benchmarking, but it has constraints when applied to unique markets like Dubai. For example, the strengths are: it offers consistent risk comparison across cities. It tracks valuation shift across economic cycles. However, the limitations are numerous. It uses lagging data. It overlooks the dominance of cash-based transactions, such in Dubai, does not account for Dubai's zero-tax freehold ownership model, and treats all residential markets equally regardless of the microeconomy, city, region, country. If we compare the population growth between 2015 and 2025, you will see that Dubai has had a 63% increase in population. We went from 2 million to 4 million. Actually, you can see on your screen, the board is going to be there now. Demographic dependence. Roughly 92% of Dubai's population is expatriate, which means that almost the entire working age and tenant base depends on external migration flows, not natural population growth, which means that when the economy slows or when the visa policies change, outflow risk can rise quickly. This volatility affects rental demand and occupancy, especially in mid-tier and service-based segments. But is that a real risk? Economic sensitivities. Because foreign residents are largely employment-linked, job losses during global downturns can directly trigger departures. In 2020, the UAE population dipped by an estimated 4 to 5% due to pandemic-related job cuts. Unlike Western cities, where citizens form the housing backbone, Dubai's demand can soften faster if global hiring slows. Policy counterbalance. However, the UAE government has introduced long-term visas, 5 to 10-year residency, and retirement residency program to stabilize the demographic base. These measures are slowly shifting Dubai from a temporary expat economy towards a semi-permanent resident model. We can see that with more and more families moving to Dubai, mitigating risk as an investor, diversify across asset types, residential, commercial, and mixed use. Prioritize developers with verified escrow account and proven delivery. Maintain liquidity buffers to mitigate macro shocks, monetary policy alignment between the AED and the USD. Disciplined diversification rather than reaction remains the most effective risk management strategy. Conclusion: Dubai's UBS classification reflects momentum, not mispricing. Its fundamentals, limited leverage, rising population and solid rental performance remain robust. UBS measures speed of appreciation, not market fragility. It is also important to note that UBS's rating methodology does not fully capture the unique nature of Dubai's market. Unlike Western economies, Dubai operates with minimal leverage, a high proportion of cash transaction, no property or income tax, and ongoing population inflows. UBS's framework assumes cyclical, credit-based behavior typical of Western housing markets, where borrowing drives bubbles. In Dubai's cases, however, growth is equity-driven, migration-fueled, and policy-managed, meaning traditional bubble indicators do not translate accurately here. Again, Dubai stands out as one of the fastest-growing cities on Earth, with its population expanding by an extraordinary 63% over the past decade, the highest growth rate among all major global hubs. This expansion is largely fueled by international migration, with expatriates now representing around 92% of the population in 2025. While such a demographic structure can create cyclical exposure, Dubai's economy remains cash-based, policy-responsive, and fiscally conservative, which significantly reduces systemic risks. The UAE microeconomic resilience reinforces this strength. With GDP growth close to 6% year-on-year, strong sovereign ratings, and diversified non-oil sectors, it continues to rank among the most stable and investment-attractive economies globally. At the same time, diversification strategies such as allocating exposures across Abu Dhabi and Dubai are proving effective for investors who want to balance growth with stability. Finally, it's important to highlight that Dubai remains one of the most affordable global cities relative to its peers. When you compare cost per square foot and rental yields to cities like London, Hong Kong, or Zurich, Dubai continues to offer exceptional value and high returns, a rare combination in today's market. In short, while the UBS's report categorizes Dubai as elevated risk, the underlying fundamentals tell a different story. High growth, high stability, high opportunity, and still only halfway through its potential. Thank you for watching this video. This was Hugo Madugera, live from Dubai.